Now we're in a routine, Jeremy, where we're raising capital even when we don't have a deal. And so when that deal does come along, our community is ready to rock and roll.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in.
All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. We're so glad you're here with us today. I have yet another amazing guest with me today, Tom Dunkel. Tom, welcome to the show.
Hey, thanks, Jeremy. It's great to be with you and your listeners today. I'm looking forward to our conversation.
Yeah, likewise. Thanks so much and appreciate your time being with us. Tom brings over 28 years of real estate, finance, and investing experience. Since launching a full-time career as a real estate investor in 2006, Tom has raised over, get this, $65 million in private money across three different asset classes, mainly self-storage, short-term rentals, and distressed mortgage debt. Prior to investing in real estate, he worked in mergers and acquisitions, closing over $1.2 billion in deals in the aerospace, IT services, software, and logistics areas or sectors. Tom, you've got quite a background. I'll call it a decorated background. So would you kindly maybe explain or articulate to our listening audience a little bit more about, kind of your background and really that transition from corporate life into now, being a very successful real estate investor?
Yeah, sure, Jeremy. I mean, when you start throwing numbers out there like 28 years, 29 years, I mean, I'm like, who are you talking about? It's gone by pretty quick, but I actually just earlier today, I hung up with my reunion committee. I have my 30th business school reunion coming up this spring, so I'm chairing that effort. But I was like, wow, where did the time go? But yeah, man, I did the business school thing, got out of there and started doing mergers and acquisitions in the aerospace industry, which was amazing. I was surrounded by such a fantastic group of people, Harvard MBAs, Harvard undergrads, Wharton MBAs, ex-fighter pilots, astronauts. I mean, it was just an amazing environment, and the company was growing aggressively through acquisition. So we were dealing with uh, private equity firms, big Wall Street private equity firms. We were putting these financing packages together with these big banks, $140 million revolving line of credit. I mean, it's so looking back on it was like, wow, that was really a great training ground. And then, fast forward, I went through a few different companies, along the way. But as far as transitioning into my entrepreneurial life, that happened kind of abruptly in 2006 when I got fired from my corporate job, and kind of landed me out on the street with with a wife and two young kids at home. But Jeremy, looking back on it, was definitely a blessing in disguise. I had been wanting to do something on my own, but when you have the golden handcuffs, because I was a vice president at a publicly traded company. And the paychecks were coming in and the stock options were kicking in and those kinds of things. So it was hard to find that ideal time to leave corporate America. And as far as trying to maybe do something on the side or on weekends, I had young kids and like to do some other things. So it's definitely challenging. But when I got summoned into that room and was told I was being let go, it definitely was kind of a wake up call to say, hey, you know what, this is it. This is the opportunity. I got to turn this negative into a positive. And so, fast forward, that was 18 and a half years ago. And, I've been able to do some pretty cool stuff along the way. And, again, as scary as it was at the time, it was also very natural feeling for me. I know different people are wired differently. But for me, it was scary, but it also felt like it was the right thing to do.
Yeah, Tom, that's fascinating. I talk to a lot of real estate investors, and their journey, their story is more of a slow roll, right? They kind of slow roll their way, into the business.
Hmm.
They might start doing real estate as a side hustle after a few
Hmm.
years, and then make that transition, from corporate life into real estate. In your case, you became a corporate refugee in the blink of an eye, right? The Band-Aid was just
Yeah,
entirely ripped off. So
that's
you,
right.
you had to have had some things going on in real estate, those, real estate related activities, before that separation with your employer. Am I correct? Or did you
Mhm.
just go cold turkey right into the business?
Yeah, up till that point, Jeremy, the only real estate I purchased was the house that I lived in. And so I had been interested in real estate. I had sort of been, I hadn't done anything other than buy my house, but I was definitely interested in it. And I think it goes back, I don't know if real estate skips a generation because my parents weren't really interested in it at all, but my grandparents were builders down in Florida. And I don't know if you can fact check me on this, but my grandfather was, or my great grandfather was probably one of the first people to offer seller financing on the planet. So he would build a house and then he would finance the sale to whoever was buying it. So anyway, so I had heard those stories growing up, and so I just kind of got interested in real estate and being a finance guy by training, but also liking real estate, I thought it was a good combination of skills that would hopefully set me up for success.
Yeah, that's great. Speaking about financing, you've raised an impressive amount of capital, $65 million in private money,
Hmm.
across three different asset classes, mainly, short-term rentals and distressed mortgage debt and
Hmm.
self-storage. What
Hmm.
strategies have you found to be the most effective, when partnering with investors on the types of opportunities that you source?
Sure. Well, we've kind of changed how we do things over the years. As you know, early on, it was really just kind of close friends and family. And we would only go and raise capital when we had a deal. And then fast forward to today, when we're really focusing on building out our self-storage business, it changed to much more of kind of your traditional pipeline and funnel kind of activities where we're really trying to attract people to our funnel, and then we educate them and nurture them and give them the information that they need as investors, because that's really at the end of the day what I am, is an investor. So we try to add value to our community by just sharing what we're seeing out in the not only the self-storage space but real estate in general, the economy, so maybe some new technologies that are coming along, making our operations more efficient at the facility level, and those kinds of things. And so when a self storage deal does come along, and we present it to our community, they're already three-quarters of the way down the path of understanding what they're going to be seeing, and then the last quarter is just the specifics of that deal. So now we're in a routine, Jeremy, where we're raising capital even when we don't have a deal. And so when that deal does come along, our community is ready to rock and roll.
Yeah, I know that all too well, that the best time
Mhm.
to raise capital is when you don't have a deal in the
That's right.
immediate future. But really appreciate your
Mhm.
perspective, on really it comes down to, educating potential investors and new
Mhm.
investors, on the benefits. Second to that, really nurturing those relationships and having, meaningful relationships, with people, other than just hoping that they're going to invest in your deal because you send an email into their inbox, once a quarter. And then
Yeah.
really just, your emphasis on providing, really providing value and having that mindset where you're here to provide value and enhance, people's lives. So really
Yeah.
appreciate your perspective there for sure, Tom.
100%. Yeah, thanks. And that at the end of the day, that's really what we're trying to do, is we're trying to help our investors build that wealth that they're looking to build so they can have a secure financial future for themselves and their families.
Yeah, amen to that. So
Mhm.
I want to kind of switch gears to talk about something that's been on everyone's mind. if it hasn't been on your mind in the last couple of years, then you've got your head buried in the sand. And that is the topic of inflation. Okay. So I'd like to hear a little bit more about maybe your perspective on, how you see inflation impacting the real estate market, particularly in the asset classes that you focus on.
Mhm. Yeah, sure. It's inflation is a funny thing. It's kind of a double-edged sword, right? So, on the assets that we own, it was a great thing, right? Because those hard assets, as the inflation goes, the real estate has historically been a great hedge. In other words, it moves with inflation. So we definitely benefited from that. But I will have to say, and this impacted not just the self-storage industry, but other industries. But one of the big drivers of demand in self-storage is that residential home trades, right? So when interest rates went from 2% to 8%, all of a sudden a lot of people were saying, hey, well, I'm not selling my 2 or 3% mortgage house to then turn around and buy an 8% mortgage house, so I'm just going to sit tight. Well, that had negative impacts across the self-storage industry because like I was saying, those residential real estate transactions and people moving is a big driver of demand in storage. So when those transactions stopped, our not just in our portfolio, but across the self-storage industry, occupancies were down, rates were coming down. Now, thankfully, at this point, we've seen that kind of bottom out and start to come back a little bit. But we definitely had to, focus in on our operations and our marketing to make sure we were, making the best out of a tough situation there. But the good thing about self-storage is, again, it is real estate based. So as the real estate increases in value, our facilities are going to increase in value, and our contracts with our customer are month to month. So theoretically, we can increase our rates every month if we. Now, we don't do that because, of course, there's a customer satisfaction element to things. So we generally are raising rates twice a year. But theoretically, we have a great vehicle to keep pace with inflation or adjust things accordingly as the economy is swinging from here to there. As opposed to being locked into a year lease or a 2-year lease or a 10-year lease.
Yeah, no, I appreciate your perspective on that. A couple questions related to the self-storage market, because we've not had a guest on this podcast before that has been in that space. My question for you is actually maybe kind of a twofold question. The first one, is, why is investing in self-storage traditionally seen as a safer type of an investment, irregardless of whether what's happening in the economic landscape? And kind of the second question to that is, do you typically support introducing technologies, into helping, manage the self-storage assets?
Yeah, great questions. Yeah, so we actually have a slide in our investor deck that shows self-storage occupancy for 40 years, just kind of gently meandering between like 80 and 90% across the industry, across the country. And so the reason that is, and if you think about the last 40 years, I mean, we've had dot-com booms and dot-com busts. We've had, pandemics. We've had, ups and downs, and, the economy has gone through these huge swings, right? But self-storage remains, pretty darn steady, at least, at the occupancy level. Rates might bounce around in there, but people are using self-storage and more and more actually. But the reason that is when things are good, right? People are buying their toys. They're buying their bikes and their kayaks, and they're buying stuff that they can't fit in their house. So they are needing a place outside of their home to store their things. We're a very consumer-driven society. People love to buy stuff, and these days you can pick up your smartphone and pretty much pick up, buy whatever you want on Amazon, and it'll show up at your house this afternoon. So that is a trend that's just going to continue more and more and more. In bad times, right? You've got, whether it's death or divorce or downsizing or some other kind of displacement, people need a temporary place to store their stuff. So they might be forced to move somewhere. They might be forced to combine households. In the case of the pandemic a few years ago, right? We had people who had that nice guest bedroom in their house. Well, guess what? Now they had to turn it into a home office. So they took out their guest bedroom furniture, and God forbid anybody gives anything away or sells it or throws it away. They store it, and then now they're working from home full time. So now they've got that storage facility full of stuff. Who knows if they're ever gonna use it again. But on the technology side of things, I mean, that's one of our huge value adds that we bring when we buy these facilities that are underperforming. They're a lot of times they're owned by a mom and pop, and they're not going to the industry conferences like us. They're not looking at the industry best practices. They're not leveraging technology to make their facility more efficient. So a quick example of that, Jeremy, is most people that buy or that rent a self-storage unit, they drive by that place and they know where it is and they want to pull in. Well, we use a hybrid management model where we're leveraging technology. So we might not have a manager at that site at that time, but what we do have is a QR code on the fence, on the gate. So the customer can scan that QR code, or if they're not comfortable doing that, they can call the phone number there. But if they're somewhat tech savvy, they can scan the QR code, fill out their rental paperwork on their smartphone, sign it with their finger, punch in their credit card information, which then gets on an auto pay. So we're getting paid every month. It turns into kind of like a Planet Fitness membership, where it's more of a pain in the butt to cancel it than to just keep paying your $100 or $150 a month for the unit. So once they finish filling out their paperwork electronically on their phone, they get their gate code texted to them right then and there. They punch in the gate code, gate opens up, they drive in the facility and do what they need to do. So we're absolutely leveraging technology as much as we can, because it just makes us way more efficient.
Yeah, I really appreciate your explaining that to our audience. I would like to switch gears now and talk about the investor. Okay, can you explain the acronym SAFE that you eloquently use as a method for passive investing, and how can investors use this approach to build a predictive portfolio?
Sure, absolutely, Jeremy. Yeah, so as I mentioned earlier, I had a kind of corporate career, and then I've been a full-time investor for 18 plus years now. And over the years, I've definitely done some things right, but I've also made some mistakes to learn from. So we've compiled an ebook, which is available on our website for free. Welcome folks to go there and grab that. It's called the Safe Investing Checklist. Now, of course, investing isn't safe, but SAFE is an acronym. And if you use the safe investing method, you might be able to de-risk some of your investing. And I also think it's a great tool for people who, they see that there's an opportunity in real estate, in multifamily, in self-storage, in whatever. But they're just not sure how to take that step because they're so used to just going the stocks, bonds, and mutual funds. So this is an ebook that just gives an outline for basically due diligence. What's due diligence? Just a fancy way of asking lots of questions, right? So SAFE is an acronym. S stands for sponsor. And investors, you got to spend time to get to know the sponsor. So many people skip right to A, which is the asset, where they want to hear about the self-storage facility or the multifamily property. Well, we'll get to that. Start with S, start with the sponsor. Who are you handing your hard-earned money over to? What is their track record? What's their background? Because you are giving them money potentially, that opens up, the gates for you to ask a lot of questions. I know some investors, they'll run background checks on sponsors, especially if they've never heard of the person before. So definitely spend some time on S, getting to know your sponsor. There's a list of questions in the ebook. Once you're comfortable with the sponsor, then you move on to the asset. What is the asset? Well, it's a self-storage facility in Douglasville, Georgia. Okay, well, maybe you want to ask some questions about Douglasville. What's that market like? What's self-storage business like? How's that going? How are you using technology to run your self-storage facility? And then once you get comfortable with the asset and you feel like you can explain it to your mother or to your young children, then you can move on to F, which is financials. What are the financial metrics of this opportunity? What are the potential returns? What are the projections? Are they believable? What are the tax implications? Those kinds of questions are in the ebook. And then lastly, E is for exit. How do you get out of this thing? It's not like you can go to schwab.com and click, click, click and sell your position in a private placement with Belrose Storage Group. It just doesn't work that way. So as an investor, you need to understand that your money's going to be tied up for 2, 3, 4 years in a value add kind of existing self-storage facility. Or if it's a development deal, it might be, 5, 6, 7 years. And so you just need to know going in what that exit looks like, what's the strategy, and what needs to happen for that exit to be possible. So that's the safe method, and about as quickly as I can explain it, Jeremy.
No, Tom, that's great. I appreciate that, and appreciate your also highlighting the fact that when you get into these things, you need to really begin with the end in mind. But what a wonderful acronym, SAFE, right? Sponsor, asset, financials, and exit. Real easy to understand and articulate.
Yeah.
My next question is really related to the higher net worth individuals, many of which we have, listening to this podcast. What are some of the common mistakes that high net worth individuals, should avoid when investing in real estate?
Sure. Well, the first one I highlighted a minute ago, which is you really need to know your sponsor. I mean, if you can possibly get with them in person, I think that is would be a huge advantage, because at the end of the day, this is someone that you're entrusting with your hard-earned money, and unfortunately, there's people out there who might take your money, or they might tell you a great story, or they might seem like hey, that's a great guy, or great girl, but at the end of the day, maybe they don't have the track record, maybe they don't have the team that you're looking for. So we have, as an example, we have a 9-figure net worth investor that's been with us for years across all the asset classes that we've been in. So 9 figures, meaning he's worth over $100 million. I think at this point he's probably worth several hundred million. But he told us years ago, he's like, because once he got to know us and trust us, and he did a deal with us, and we made him money, and we did everything we said we were going to do. He told us, he said, hey, that's to him, that was like the big thing, was can he trust the operators? He's like, look, he's a big boy. He knows if something happens in the market that we have no control over, maybe things aren't going to go as well as we hoped, but he knows that he can trust us because we've done right by him on a prior deal. So he said for him, that's just a huge hurdle to get over, and why he doesn't do deals with 100 different sponsors. He's got a handful of sponsors that he's handpicked and curated over his career that he does business with, and that's it.
It makes a lot of sense, Tom. What would you say to that newer investor, maybe that individual that has never deployed capital before in any type of a, private placement, real estate syndication? Maybe they've heard about passive investing, but they're just not sure where to start.
Sure. Yeah. I guess I would say a couple things. Number one is, definitely read the materials. But what you'll find in the materials, it'll say, minimum investment $100,000 or minimum investment $50,000. Well, guess what? Most sponsors are companies like Belrose Storage Group. We're an agile, smaller company, and we would absolutely flex on our quote unquote minimum if we, if and this happens a lot, right? An investor will come to us, hey, this is my first deal. Will you take 25,000? Of course we will, especially if we see that as a potential gateway to them maybe on the next deal writing a check for $250,000. So I would say, definitely push on some of those, investment minimums. I have to tell you, even though I'm here as a self-storage guy, at the end of the day, I'm an investor, and I think a great gateway drug, sorry to use that term, but a gateway drug for a new investor is lending. So if you can find a trustworthy like fix and flip guy in your market, those guys are oftentimes looking for private loans because for whatever reason, they can't get a loan from a bank. But I do a lot of private lending on the side where I'm secured by real estate. I'm in first position and I'm getting, maybe 9, 10, 12% in that first position as a way to get started outside of stocks, bonds, and mutual funds. I really, really like that because then it kind of opens your eyes to that whole world, and it's really very low risk if you get the right sponsor. It's very low risk, and it's a great way to get started.
I couldn't agree with you more. When I got started on my real estate investing journey, we
Mhm.
were in the fix and flip, side of things, but I was
Mhm.
basically the private money lender, right?
Mhm.
Putting my own capital, on the line and investing it really, with the team. Well, who's the team, right? It's the general contractor, it's the property manager if there is one. It's
That's right.
even down to, who's dealing with who's the decorator, right? Who's going to ultimately, decide, what's going to go into that, refurbished product. So really appreciate your perspective there. Tom, what's next? What's next for you? As we kind of look to round out 2024 and move into 25, what's next on your bucket list, personally or professionally?
Yeah, sure. So, well, personally, if I'm being perfectly honest, I'm looking to work less. We built a great team here at Belrose Storage Group, so I'm finding myself delegating out more and more to our team, so that I can kind of, work on some more bigger, strategic kinds of things. But we have two niches within the self-storage niche that we're really excited about, and we're looking to, really go whole hog into next year. One we touched on, I think, before we hit record today was boat and RV storage. So it's a market there's a huge supply and demand imbalance. There's lots and lots of boats and RVs being sold every year, but there's not really any new parking places being built. And homeowners associations and such, they don't want the boats and the RVs parked in the neighborhood. So we have customers at our facilities, they're driving half an hour, 45 minutes, over an hour to park their RV at our facility because there just are not a lot of these kinds of facilities around for these people. So we really like the boat and RV market. And the other one that we really like, Jeremy, we call pro storage. So this is think contractors, landscapers, the HVAC guy, the plumber, the carpenter, these are, instead of like a 10 by 10 kind of unit with an 8-foot roll up door, these are 18 by 25 units with a 14-foot roll up door, 20-foot ceiling. So a contractor can pull their van in there. They can pull their truck in there. They can store their tools in there, materials, etc. So this is another area where there's a big supply and demand imbalance. And because I don't know if you try to get any work done at your house recently, but contractors these days are super busy, very much in demand. They're trying to grow their businesses, but they're probably too small to be able to afford like a big flex space, but they're too big to keep working out of their garage or their basement at home. So we have these facilities we bought one and we're looking to buy more, but they're hard to come by. So now we're looking to start building these out starting next year.
Yeah, when you were talking there, Tom, what you said really resonated with me. I live in an association maintained community, and I can tell
Mhm.
you my neighbors don't appreciate when I put my 40-foot RV in the driveway, weeks and weeks and months at a time. And my two teenagers started up a outdoor services business, and they've got a lot of different equipment
Mhm.
and trailers and what for that side hustle, so to speak, that they started. So certainly can appreciate your perspective there. What would maybe
Awesome.
be, as we kind of wrap up here, what would maybe be one or two different ways that our listening audience can learn more about you and connect with you?
Sure. It's been great, Jeremy. Great questions. Really enjoyed our time together. Yeah, again, I'm Tom Dunkel. I'm the Chief Investment Officer here at Belrose Storage Group. You can find us at belrosestorategroup.com. If you Google me, you can find me on LinkedIn. You can find lots of my podcast episodes. and other value add, hopefully, material out there. And always happy to talk to new investors, see if we can get you started in alternative investments, so you can build that predictable investment portfolio for you and your family.
Yeah, sounds good. And Tom, really appreciate your time with us today and for providing such tremendous value to our listening audience.
Thanks, Jeremy.
And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.